Welcome to the deep dive. We're diving into the world of investing today with excerpts from A Random Walk Down Wall Street, a classic. And this book, it said something that might surprise you a little bit. It says that beating the market consistently, well, it's really tough, like almost impossible. Think about it. You're trying to outsmart what, millions of other investors? All of them have the same info you do.
Yeah, that's the really cool part of this book. It's not, it doesn't give you some secret formula or tell you to chase the hottest stock tip. It's a random walk down Wall Street, it argues, for something more like level-headed, embracing, kind of the randomness of the market.
So no get rich quick schemes, huh?
Nope, not really. The book is all about the long game. It focuses on things like index funds and asset allocation. You tailor that to your own goals and how much risk you can handle.
Okay, so that's different from the whole buy low, sell high thing we hear all the time. But before we get into all that, the book dives into some pretty fascinating market history, right? Like tulip mania and the dot-com bubble, those kinds of things.
Absolutely. A random walk down Wall Street uses all these historical examples, to show how these market bubbles, how they form, and how dangerous those speculative frenzies can be. And it all starts with a story that sounds almost unbelievable. Tulip mania in 17th century Holland.
I've heard of that one, but remind me what happened there.
Okay, imagine, like, picture a world where people are mortgaging their homes to buy tulip bulbs. I mean, it sounds crazy, but that's how wild it got during that tulip mania peak.
Yeah.
The bulbs became like status symbols, and the rare ones, they were going for crazy prices.
It's hard to believe, right? Like something as simple as a flower bulb, a tulip bulb, could cause such a massive, speculative bubble.
It really shows you how powerful those psychological factors are in the market, like fear of missing out, herd mentality, all that stuff. It can make people do things that don't make sense, even experienced investors.
So it's not just about tulips, it's about human nature, isn't it? And we see this pattern over and over in history.
You got it. And a random walk down Wall Street, it highlights another really captivating example, the 18th century South Sea bubble in England. This one involved a company they had a monopoly on trade with South America, and speculation, just rumors running wild, drove their stock price up like crazy.
Didn't the king even get mixed up in that one?
He did, yeah. And the fallout from that South Sea bubble, it was so bad, they had to pass this bubble act. It basically stopped new companies from forming in England for over a century.
Wow. Talk about a long-lasting effect. Huh?
Oh,
So we've got tulips, trading companies. What other historical bubbles does the book talk about?
well, you can't talk about bubbles without mentioning the big one, right? The 1929 crash in the U.S., the Roaring Twenties, they had this incredible economic growth, but so much of it was built on speculation, especially in the stock market.
Yeah. It's the classic example of how excitement and optimism can turn into panic so fast. But haven't we seen similar things happen more recently? I'm thinking like the dot-com bubble.
Oh, absolutely. The dot-com bubble, late 90s, early 2000s, you had investors throwing money at internet companies, barely even looking at, how much they were actually worth. Sounds familiar, right?
Yeah, it does feel like some trends we've seen lately. But before we get too sidetracked, the book doesn't just focus on all the bad stuff, the crashes and bubbles, does it?
Not at all. It does acknowledge the risks of speculation, but it also gives you this framework, right? This way to think about making smart investment decisions, and it's all about that long-term perspective.
Okay, good. Because I was starting to think maybe I should just bury my money in the backyard.
Hmm.
So how does the book connect all these cautionary tales, the history stuff, with a strategy for investing?
Well, it shifts the focus to compounding. The idea that even if you invest small amounts, but you do it consistently over time, it can grow like crazy.
Yeah, like the snowball effect of compounding. I've
Mhm.
heard that, but it's hard to wrap your head around sometimes.
Right. The book gives you this really striking example, though. Think about this. $1, just $1, invested in stocks way back in 1802, that would be worth millions today. Millions. It really makes you realize that time is the most important thing when it comes to investing.
Okay, yeah, that's starting to sink in. Patience is key. But where does a random walk down Wall Street say we should put our money for this long-term growth?
It really pushes a strategy that might surprise you, especially if you're, looking for those huge returns. It's index funds. Instead of trying to pick individual stocks, winners and losers, a random walk down Wall Street, it says you should invest in these funds that track the whole market, like the S&P 500.
Index funds, huh? I've heard of them, but that admit they don't sound as, as exciting as trying to find the next Apple or Tesla or whatever.
Oh, I know. That's how most people think about it. But a random walk down Wall Street, it busts that myth, about how great stock picking is. Even for the pros, it's really hard to consistently beat the market. It even talks about these studies. They showed that these fancy, actively managed funds, they often don't do as well as those plain old index funds,
Yeah.
especially when you factor in all the fees they charge.
So it's more about like accepting that we probably can't beat the market, but we can, ride the wave, ride the overall growth.
Exactly, that's the idea. And index funds, they're a good way to do that. Cost effective, diversified. Makes sense.
Right. Yeah, yeah, starting to see the logic here. But a random walk down Wall Street, it goes beyond just index funds, doesn't it? It talks about some bigger investing principles, things that can guide us no matter what we're investing in.
Right, you got it. It lays out 5 key principles for asset allocation. Those are the foundation of a solid investment strategy. We've got risk and reward, time horizon, dollar cost averaging, rebalancing, and risk tolerance.
Wow, that's quite a list. Let's start breaking those down one by one, starting with risk and reward. What's the takeaway for the average investor?
Okay, so this principle, it highlights, it shows you that basic link between risk and how much you might earn. Basically, the more you could potentially earn, the more risk you're taking.
So it's about like finding that balance, right? Where you're comfortable with the amount of risk.
That's it, exactly. And a random walk down Wall Street, it stresses how important it is to make sure your investments match, your personal risk tolerance.
Makes sense. Makes sense. We all have different comfort levels with the idea of losing money. But how do we figure out our own risk tolerance? Is it just like a feeling, or is there a way to like figure it out more systematically?
That's a really good question, and it's one that we'll definitely dig into more as we explore all those other principles in a random walk down Wall Street. But before we get there, I do want to touch on another interesting idea from the book. It's about the limits of expertise.
Okay. I'm curious about that. We've been saying how tough it is to beat the market, but what about, all those financial gurus we see on TV? Are they kidding themselves, or do they really have some secret knowledge?
Well, a random walk down Wall Street, it's pretty skeptical of market timing and technical analysis. Those attempts to predict, what prices are going to do in the future based on charts and other indicators.
So those fancy charts and algorithms and all that, they might not be as reliable as people think.
Right. The book talks about these studies. They showed that even the pros, the analysts, they often can't consistently do better than the market. One study even it compared expert stock picks to, get this, darts thrown at a list of stocks. And guess what? The darts did just as well, sometimes even better.
Wow, that's kind of funny, but also kind of scary. So if even the experts can't really predict what the market's going to do, where does that leave us?
It brings us right back to that main message of a random walk down Wall Street, right?
Yeah.
Instead of trying to be smarter than the market, focus on building a solid strategy long term based on sound principles.
Okay. Yeah, I'm starting to see the wisdom in that. But I still have so many questions about, about how to actually do it. How do I like figure out my risk tolerance, allocate my assets, all that, and how do I choose the right investment?
Those are all great questions, and we'll get into them. We'll explore all of that as we continue our deep dive into a random walk down Wall Street.
All right, we're back with our deep dive into a random walk down Wall Street, and ready to tackle those 5 key asset allocation principles, those big ideas you mentioned. So where do we start?
Well, we were just talking about risk and reward, so let's move on to to time horizon.
Yeah.
This principle basically says you gotta match your investments to your financial goals.
Yeah.
And the time you have, to reach those goals.
Okay, yeah, that makes sense.
Yeah.
Like if I'm saving for retirement and that's, decades away, I probably have more room to handle those market ups and downs.
Mm-hmm.
More than someone who's say saving for a down payment on a house next year, right?
Exactly. A random walk down Wall Street, it suggests that if you've got a longer time horizon, you can put more of your money into stocks, because historically stocks, they give you higher returns, but they're also more volatile.
So it's like balancing that potential for bigger growth with the risk of, losing money in the short term.
That's the key. And then as your time horizon gets shorter, like say you're getting close to retirement, then it's usually a good idea to shift to start moving towards more conservative investments like bonds, because that helps you protect your money, and minimize those sudden losses.
It's almost like adjusting the sails on a ship,
Right.
depending on the wind and how far you need to go.
That's a great way to put it. Now let's talk about dollar cost averaging. This is a principle that can help smooth things out no matter what your time horizon is.
Okay, dollar cost averaging. I've heard that term, but I'm not totally sure I get it.
It's actually pretty simple, but it's powerful. It just means
Oh.
you invest a set amount of money, the same amount, at regular intervals, like every month or every quarter, no matter what the market's doing.
So instead of trying to, time the market perfectly, buy low, sell high, all that, you're just taking the guesswork out of it.
Exactly. You're basically using those market ups and downs to your advantage. When prices are down, you're buying more shares. When prices are up, you buy fewer. So over time, you're averaging out your purchase price.
Yeah, that sounds like a good way to avoid, the emotional roller coaster, all that stress of trying to predict every little market move.
It is a random walk down Wall Street. It really emphasizes that dollar cost averaging it's really good for long-term investors. It helps you avoid those mental traps, those biases that can lead to bad decisions.
Speaking of mental biases,
Yeah.
you mentioned risk tolerance,
Yeah.
right, as one of those key principles. But isn't that kind of subjective? Like, how do we actually measure our own, risk tolerance?
You're right. It is personal. It's all about understanding how comfortable you are with the possibility of, your investments losing money. Someone who's really comfortable with risk, they might be okay with seeing their portfolio go up and down a lot in the short term. But someone who's not as comfortable with risk, they're going to prioritize, keeping their money safe, preserving their capital.
So it's not just about like how much money you have to invest. It's also about like your emotional capacity, right?
Yeah.
How much you can handle those swings.
Absolutely. And a random walk down Wall Street, it acknowledges that risk tolerance, it can change over time. It can be affected by things like your age, what's going on in your life, your financial goals, and even your experiences in the market.
Yeah, I can see that. Like even someone who's usually okay with risk, if they go through a big market crash, that might make them rethink things, right?
Right.
But how do we take this idea of risk tolerance and how do we actually use it to make investment choices?
Well, it all comes back to asset allocation. Once you know how much risk you're comfortable with, you can build your portfolio around that. So, for example, someone with a high risk tolerance, they might put a bigger chunk of their money into stocks, but someone with a low risk tolerance, they might prefer to put more into bonds or other, safer investments.
Okay, so risk tolerance, that's like the guiding principle, right? It informs all those asset allocation decisions. But a random walk down Wall Street, it also mentions rebalancing as a key principle. What's that all about?
Rebalancing, it just means adjusting your portfolio every so often to make sure it still matches your target asset allocation. Because over time, the value of your investments is going to go up and down, and that can cause your portfolio to drift away from how you originally set it up.
So like if my stocks do really well and they grow faster than my bonds, then my portfolio might become too heavy on stocks, even if my risk tolerance hasn't changed yet.
Exactly,
Mm.
exactly. And that's where rebalancing comes in. It basically means you sell some of those assets that have done really well and you buy more of those that haven't done as well. And that brings your portfolio back into balance.
Like it's like trimming a hedge, you know.
Yeah.
You keep it looking nice and neat.
That's another great analogy. And a random walk down Wall Street points out that rebalancing, it not only helps you manage risk, but it can actually help you get better returns over time.
Really? How does that work?
Well, it forces you to sell high and buy low, right? But you're doing it systematically by selling some of those assets that have gone up a lot and then using that money to buy those that have lagged behind. You're basically taking advantage of those market swings, maybe buying things at a discount.
Yeah, that makes sense. It's like having this built-in discipline, right? It helps you
Well,
avoid those common mistakes people make when they're, letting their emotions drive their decisions. But I got to say, these five principles, they're really interesting, but they also feel kind of abstract sometimes. How do we actually use them like in the real world?
You're right. It's one thing to understand the ideas, but putting them into practice, that can be tough. That's why a random walk down Wall Street, it doesn't just stop at the theory. It actually gives you some real practical guidance, right? To help you build a portfolio that's right for you.
Okay, now we're talking. What kind of specific advice does it give?
Well, it starts with understanding your financial situation right now. Figuring out what assets you have, what debts you have, how much money you're making, how much you're spending, and of course what your financial goals are.
So it's like taking a financial inventory, right? Before you
Yeah.
before you start building your investment portfolio.
That's a good way to put it. Once you have a clear picture of your finances, then you can start making good decisions about asset allocation, diversification, and what specific investments to choose.
And that's where those five principles come in,
Right.
right? Risk and reward, time horizon, dollar cost averaging, rebalancing, and risk tolerance. We use all of that to make those choices.
Exactly. A random walk down Wall Street, it gives you this framework, this way to think about those decisions, right? So that they match your situation and your goals.
This is starting to feel a lot less overwhelming. It's not about like becoming a financial genius overnight. It's more about using these principles, applying them to create a strategy that's personalized, right?
Exactly. And remember, as your life changes, your investment approach should change too. A random walk down Wall Street, it encourages investors to check their portfolios regularly and make adjustments to make sure they're still on track, with their needs and goals.
So it's not like you do it once and you're done. You gotta stay involved. You gotta adapt as you go. But I gotta admit, even with this framework, even with these ideas, just the thought of choosing investments, it can be a little scary. There are just so many options out there. Where do you even start?
I know. A lot of people feel that way. But a random walk down Wall Street, it offers some really good advice here. Keep it simple, stick with index funds.
Right. The index funds, those are the ones that track the whole market
Mm,
instead of trying to pick individual stocks, right?
exactly. The book suggests that index funds, they can be a really solid foundation for a diversified portfolio,
Mm.
especially if you're new to investing or if you just don't have the time or the expertise to manage your investments actively.
Yeah, yeah, they sound like a good starting point. But what about people who are, a little more adventurous, people who want to explore other types of investments?
A random walk down Wall Street, it doesn't ignore those other options. It talks about things like individual stocks, bonds, real estate, even alternative investments like commodities, precious metals, things like that. But it warns you, don't get caught up in the hype. Always do your research. Be careful.
So it's about balancing, right?
Yeah.
Balancing that desire for bigger returns
Yeah.
with a healthy dose of caution,
Yeah.
a little bit of skepticism.
Exactly. And remember, diversification. Diversification is key. Don't put all your eggs in one basket, right?
Yeah.
Spread your investments out. A random walk down Wall Street, it stresses this over and over again. Different asset classes, different sectors, industries, even different parts of the world.
It's like building a safety net for your portfolio,
Yeah.
right? But diversification can get pretty complicated, especially once you start going beyond those basic index funds.
It can. It definitely can. And that's where risk tolerance comes back in. How much risk you're willing to take, that's going to influence how much you diversify and what you invest in. A high-risk investor, they might be okay with a more concentrated portfolio, just a few carefully chosen investments. But a low-risk investor, they're probably going to want to diversify more broadly.
Okay, so we've talked about asset allocation, diversification, index funds.
Yeah.
What other practical tips does a random walk down Wall Street give us to help us navigate the world of investing?
Well, one thing it really emphasizes is minimizing costs,
Hmm.
especially those pesky fees that come with mutual funds and other investments.
Yeah, I've heard that those fees can really add up over time, right? Like they can eat into your returns.
They can, for sure. And a random walk down Wall Street, it really pushes you to choose low-cost index funds and ETFs and to watch out for those actively managed funds. They often have really high expense ratios.
So it's not just about picking the right investments, it's also about being smart about the cost, like
Yeah.
making sure you're not paying too much.
Exactly. And speaking of costs, you got to think about taxes too. A random walk down Wall Street, it actually gets into the tax implications of
Oh
investing.
yeah, taxes. Can't forget about those.
Nope. And the book gives some good advice on how to manage your investments in a way that's tax efficient. It talks about things like tax loss harvesting, which means selling those investments that are losing money to offset capital gains. And it talks about investing in those tax advantaged accounts like IRAs and 401ks.
So it's not just about how much you make, it's about how much you get to keep after the government takes its share.
Right. And finally, a random walk down Wall Street reminds us that investing, it's a long game. It's not about getting rich quick.
It's about patience, discipline, staying focused on your goals, even when the market's going crazy.
Exactly. And remember, you don't have to figure it all out on your own. A random walk down Wall Street, it actually encourages you to get help from a financial advisor if you need it. They can give you personalized advice, help you make a plan, and just, support you as you navigate the market.
Yeah, that's good advice. This deep dive into a random walk down Wall Street, it's been really eye-opening. We've learned about market history, we've busted some investing myths, and we've explored some really practical strategies for building a portfolio.
And most importantly, I think we've seen that anyone can be a smart investor. With a little bit of knowledge and some effort, you can reach your financial goals.
Absolutely. Now, before we move on to the final part of our deep dive, let's take a moment just reflect on everything we've covered so far.
Hmm.
Okay, so we're back for the final part of our deep dive into a random walk down Wall Street, and this book it's really made me rethink some of my ideas about investing.
Yeah, it's a classic for a reason. It cuts through all the hype and the noise, and it just lays out this really clear way to think about investing. And it's surprisingly easy to understand too.
Yeah, exactly. We've talked about all that market history, those five big principles for asset allocation, and even like the limits of expertise. But I'm really interested in getting into the nitty gritty,
Hmm.
the practical stuff, the advice a random walk down Wall Street gives for actually building a portfolio. Like, okay, we get the theory, but how do we actually do it?
Right, right. It's all about like taking that knowledge and turning it into action. And one of the biggest pieces of advice the book gives is to really start by understanding your own financial situation right now. Like, where are you at?
Okay. Yeah, that makes sense. It's like taking inventory, before you go on a trip, you got to see what you've got, what you need. So what does that assessment involve? Like what do we need to look at?
Well, you got to look at the big picture, right? All your finances. So, your assets, that's your savings,
Mm.
any investments you have, any property you own. And then you got to look at your reliabilities too. That's your debts. Things like, your mortgage, student loans, credit card balances, all that.
So it's about getting a clear picture of your net worth,
Yeah.
right? Like what you own minus what you owe.
Exactly, exactly. But it's not just about like a snapshot in time. It's also about looking at your income and your expenses. Like, how much are you bringing in each month and where's all that money going?
Yeah. Yeah, that's where budgeting comes in, right?
Yeah.
Tracking your spending, figuring out where you can cut back, save more.
Right, right. The more you can save, the more you can invest, the faster you're going to reach your goals. And speaking of goals, that's another big part of this whole assessment.
Oh yeah, the goals, the financial goals.
Yeah.
We talked about how important those are for deciding on your investment strategy.
A random walk down Wall Street, it really stresses how important it is to make sure your investments they line up with those goals. What are you saving for? Retirement, a down payment on a house, your
Yeah.
kids' college. Each goal is going to have a different time horizon, right? And a different level of risk that you're comfortable with.
So it's not just about like making as much money as possible. It's about like what you want to do with that money, what you want to achieve, and that helps you figure out how to invest.
Exactly. Exactly. Once you've got a good handle on your financial situation and your goals, then you can start thinking about, how those five big asset allocation principles we talked about, how those can help you build a portfolio that's right for you.
Okay, yeah, yeah. Let's connect the dots here.
Yeah.
How do those principles? How do they actually help us make those investment decisions?
Well, your risk tolerance, that's a big one, right? We talked about that before.
Yeah.
That's going to have a huge impact on how you allocate your assets. Remember, asset allocation, that's all about like spreading your investments across different types of assets, like stocks, bonds, real estate, all that. So you're managing your risk and trying to get the best
Yeah,
returns.
right. And a random walk down Wall Street says that if you've got a higher risk tolerance and a longer time horizon, you might put more of your money into stocks. But if you've got a lower risk tolerance or your time horizon is shorter, you might want to be more conservative, put
Mhm.
more in bonds.
Yeah, exactly. And then within those broad categories, stocks, bonds, whatever, diversification is super important. Remember, don't put all your eggs in one basket. A random walk down Wall Street, it really hammers that home. Spread your investments around different sectors, different industries, even different parts of the world.
So like even within stocks, you wouldn't just invest in like one or two companies, right?
Yeah.
You'd spread it out, different industries, maybe even some international stuff.
Right, exactly. Diversification, it helps to like cushion the blow if any one investment does badly. You're not putting all your hopes on one thing.
Yeah, yeah, that makes sense. It's like having a backup plan, a safety net for your portfolio.
Yeah.
But managing all that diversification, that can seem kind of overwhelming, especially if you're not like a financial expert.
It can be, but that's where a random walk down Wall Street has some really good advice. They say keep it simple, stick with index funds.
Ah, index funds.
Yeah.
Those are our friends. We've talked about them a lot. But remind me, why are they so good for the average investor?
Well, index funds, they're just a really easy and affordable way to get that diversification, without having to pick individual stocks instead of trying to
Yes.
like beat the market. You're just right in the way of going along with the overall growth.
They're like a one-stop shop for building a diversified portfolio.
Yeah.
But there are so many index funds out there. How do you choose which ones to invest in?
A random walk down Wall Street recommends going with index funds that track, those big broad market benchmarks like the S&P 500. That's the 500 biggest companies in the US, the ones that are publicly traded.
Okay, yeah, so that covers a lot of the U.S. stock market. But what about international stuff? Should we be investing in companies outside the U.S.?
Definitely, including some international stock funds in your portfolio that can help you take advantage of, growth opportunities around the world, and it can help reduce your risk even more.
So we're really spreading our bets, huh? Different countries, different regions, building this super diversified portfolio.
Exactly. And remember that dollar cost averaging strategy we talked about, that's a really good approach to use when you're investing in index funds.
Right, right. By investing the same amount regularly, no matter what the market's doing, you're you're kind of smoothing things out, averaging your purchase price over time, and that can help reduce risk too.
Exactly. Exactly. And speaking of reducing risk, a random walk down Wall Street really emphasizes how important it is to keep your investment costs low.
Yeah, yeah. Those fees can really eat into your returns if you're not careful.
They can, for sure. That's why the book says you should stick with those low cost index funds and ETFs and watch out for those actively managed funds. Those often come with really high fees.
So it's not just about making money. It's about keeping as much of that money as you can, right? Not letting those fees eat it all up.
That's right. That's right. And don't forget about taxes. A random walk down Wall Street, it actually gets into the tax side of things too.
Oh yeah, taxes, taxes. Always got to think about those.
He gives some good tips on how to manage your investments in a way that's tax efficient. Like it talks about tax loss harvesting. That's where you sell investments that are losing money so you can offset, capital gains. And it talks about investing in those tax advantaged accounts like IRAs and 401ks.
So it's not just about how much you earn. It's about how much you get to keep, right? After the government takes its share.
Exactly. And all this advice, all this stuff about asset allocation, diversification, keeping costs low, it all comes back to that core message from a random walk down Wall Street. Investing, it's a marathon, not a sprint. It's a long game.
Patience, discipline, staying focused on those long-term goals, even when the market is trying to, throw you off track, make you panic.
And remember, you don't have to do this alone. A random walk down Wall Street, it actually encourages you to talk to a financial advisor if you need help. They can give you personalized advice, help you make a plan, and just, support you along the way.
This deep dive into a random walk down Wall Street, it's been amazing. I've learned so much. We've uncovered all these secrets of market history. We've busted some investing myths, and we've really explored some really practical ways to build a portfolio.
And I think the biggest takeaway is that anyone can be a good investor. With a little knowledge and a little effort, you can achieve your financial goals. It's definitely possible.
Absolutely. Thanks for joining us on this journey, everyone. And remember, the best investment you can make is in your own financial education. Keep learning, keep exploring, and you'll be well on your way to reaching your full potential as an investor.